but instead we could be bottoming. Maybe this week.
I love Tom Lee's optimism for investing, and he is exceptionally smart. He believes the past 2 weeks has hit the bottom for the markets, and that was driven from the tariffs that just went into effect.
President Trump tonight with another new stance on his own trade war, a partial reprieve on his 25% tariffs on goods from Mexico and Canada.
What's that? Oh, okay. So now the tariffs are going into effect in April. Whether the tariffs are enforced now or we kick the can for another month, I think that we all recognize that tariffs are poison for the markets. For that reason, I believe that there's a little bit more room before we hit the full bottom. And if you're curious, throughout this entire dip, I have not sold any of my stock, and I'm going to give you some statistics why in just a moment. And if you happen to be on my newsletter, then you know that I sold a lot of my stock to take some margins and build up cash reserves to be defensive. And that was about 2 months ago. And since then, I've put a lot of that cash back into the market to buy on this latest dip. And if you know me, then you know that the market crash of 2008 is what really helped set me up for hitting my first million right after graduating college. And this moment is about to be a huge opportunity for many of you to blow up your net worth. That's why so many of the big name analysts predict that the next 90 days will create the next round of millionaires. And I genuinely hope that's you. In this video, I'm going to cover the history of market corrections, the sectors that performed the best during a market downturn, and last, I'll cover the companies that I just bought on this massive dip to give me the best returns. But I have a quick request. If at the end of the video you appreciate my transparency and my analysis, I'd appreciate your support for the channel. Also, at the end of the video, I don't have a giveaway, but I do have a proposal for 10 of you watching to have a virtual happy hour. But before I discuss past recessions, I should probably give a technical definition of what a recession is. It's defined as 2 back-to-back quarters of negative gross domestic product, and recent forecasts have this first quarter coming in at about a negative 2% GDP, which is about a 6% swing from where it was before the tariffs were even a thing. Sadly, a recession isn't defined until after we're already living in it. And the average recession since World War II has lasted 11 months. And the average stock market recovery is 12 to 24 months. Sadly, the average bull run is only about 3 years. And lo and behold, we are coming up on 3 years since the last correction in 2022, which was down negative 25%. But the reason why I stated early on that I didn't sell any of my stock during the market declining is because people that sell out of fear and then try to time when to get back into the market, they stand to lose the most. This chart shows $10,000 invested over 19 years. If a person kept their money invested every day, it was worth over $64,000 at the end of 19 years. But if a person missed the top 10 best trading days, it would be less than half that amount at $29,000. And 7 of the best days happened in bear markets. In fact, in 2020, the second best day happened to be right after the second worst day. My point in sharing the chart is that once the market starts dropping, it's extremely risky to try to sell and then time the market to get back in, because some of the best days happen right after the worst days. But when the market does have a major drop, then it's ideal to keep investing to dollar cost average. And of course, a lot of keen investors choose to double down on their investments when the markets have a steep decline, because of what I just showed you in the chart. Now, when I made my first million, it's because I knew the opportunity from the 2008 crash was a once-in-a-lifetime opportunity. And instead of hoarding my cash like most everyone else around me, I invested it wisely. But truth be told, the hardest part was trying to keep a job since layoffs were happening almost every other week. Literally, I would say that about 70% of all of my friends lost their job during that 6-year recovery. If you lived it, then you know I'm not making that up. Now on this next chart, it shows some of the downturns over the past 20 years and the top performing sectors during that time. Consistently, the sectors of consumer staples and utilities have done the best during those times. But in 2018, we had a downturn due to a trade war, which involved tariffs and is very similar to what we see today. And in that case, healthcare did the best, which I find very interesting because when you deep dive Warren Buffett's Berkshire Hathaway stock the past several months, in addition to them increasing their cash holdings, they've been increasing their investments in energy, healthcare, and consumer staples, while decreasing their technology holdings. Given what I've just shared with you, you have to admit, it sure seems like he knows what he's doing. And this is also good affirmation to have a little bit of diversity in your investments to create some balance. So the big question is, What do we pick to invest in during the current and potential future drop as we continue to have these tariff talks? Well, when we had a trade war in 2018, AMD was one of the top performing stocks during the recovery with over 150% return, and semiconductors as a whole did very well with the top 3 stocks. So on this current dip, I chose to focus on mega cap stocks with strong fundamentals, large cash holdings, strong cash flow positions, limited exposure to tariffs, and industries with very high margins. I didn't pick any small caps because during times of downturns, investments in small caps often dry up, and investors don't reward companies with poor fundamentals. And when you look at the most recent pullback in 2022, most all of the top 10 performers during the recovery fit within my criteria. So my first company on my list is Microsoft, which already took a hit in 2024 for its investments in AI without showing stronger results from Copilot. But more recently, they've since revamped Copilot to give it a little bit more functionality and training their own form of models versus just relying on OpenAI. I've spoken to the evolution of AI over time, where investments in data centers will begin to peak, and then the AI agents and the software phase will really begin to increase. This is where Microsoft stands to monetize these types of features and begin to roll it out in the next year or so. In addition to this, they have cut off all of their support for Windows 10, which will force people to upgrade to Windows 11, which in turn will increase their sales and revenue. And as a matter of fact, Microsoft has over $75 billion in cash. And that in itself is a higher amount than the market cap of 97% of all US public companies. Without a doubt, that's a lot of money. Microsoft's past 1 year performance is pretty bad at a negative 2%, but the PDE ratio of a 32 is healthy with plenty of room to grow. And if you look at the seasonality of the stock, it has historically dipped in mid-March and had strong growth through August. And an item to point out is that the average fair value of the stock is at $468 with about 20% upside. For me, Microsoft is a safe investment long-term on a dip like what we're seeing today, and it's better equipped than most to weather a storm from a potential trade war. It's true that when the market pulls back, I tend to focus on mega cap companies, but new innovation creates big opportunities too, which brings us to our sponsor, ALZN Neuro. ALZN Neuro is a biotech company developing treatments for Alzheimer's, bipolar disorder, depression, and PTSD, conditions affecting over 43 million Americans. Their lead product, AL001, is potentially safer, more effective co-crystal lithium treatment requiring up to 50% less intake for the same benefit. Preclinical studies showed higher lithium delivery to the brain, with lower blood exposure, possibly reducing kidney and thyroid risks. Early trials confirmed its strong safety profile. With upcoming studies partnered with Mass General Hospital and Harvard Medical School, AL001 could gain faster FDA approval via the 505B Section 2 pathway. It may replace or complement antidepressants and completely replace lithium carbonate. Their next trial will use advanced imaging technology created specifically for these studies to validate the prowess of AL001. ALZN is also developing ALZN002, an Alzheimer's vaccine designed to help the immune system clear harmful proteins for a safer, long-lasting treatment. To learn more about ALZN Neuro, feel free to check out the link down in the description. The next company is Palantir, which I have spoken about a lot over the past few years based on its potential. And now that it is a household name, it is the literal tip of the spear when it comes to the next phase of AI and the push for systems, integrations, and agents. This company has a massive moat around it, and they're about 5 to 10 years ahead of anyone else with what they provide. They are also one of the few companies that have a proven track record working with government contracts. And I want to quickly point out that Palantir just made a positive margin in 2023 for the first time. They went from a negative to a positive to having a 16% margin in just 3 years. And when you account for their commercial business growing 64% year over year, that means their margins are about to have a large breakout this year. In addition, Palantir stands to continue to have strong growth from its federal funding, since the defense budget is one of the only ones mentioned to be expanding. And another opportunity exists in that the stock has fallen over 30% from its high just last month. I'm the first to admit that Palantir doesn't fit within all of my criteria for being a mega cap company, but they are cash rich with $5 billion, and the fundamentals are very strong. This is one where I'm not dumping a lot into it right now, but I am dollar cost averaging and investing regularly. To me, there still exists the potential for Palantir to dip down to $70 in the next few months. And if that happens, then I'll definitely double down. And my next company is nvidia, which I know a lot of people will say that's a poor choice because in the last trade war, semiconductors were hit pretty hard. But if you recall, semiconductors were also the top performing companies during the recovery. Now, just hear me out for a second. nvidia is down negative 18% for the past 3 months. And that is great news for investors that want a chance in. And their cash holdings are at $43 billion, which is an increase of 40% in just 1 year, while their assets nearly doubled and their debt went down 10%. And when you look at their fundamentals across the board, they are absolutely great. This is a better picture than most any company you'll ever review. And analysts see a lot of upside of around 57% over the next 12 months. There are absolutely no sure things when it comes to investing, but this company has so much going for it between its fundamentals and its high demand for all of its products that it's a definite for my list. And to its defense, the stock took a beating because they've had some issues with their new Blackwell chips. They've had headwind from the news that DeepSeek can create models on the cheap. To me, those factors are just near-term noise, and they're not long-term issues. And this is why I doubled down on nvidia, because their hardware will continue to be in high demand because AI is evolving past basic inference and LLMs that are now just a commodity. It is quickly transitioning to Agentive AI. And I promise you, you're going to start to hear this term or a term like it quite a bit in the next year, because we are at a point where the AI agents will begin to accomplish complex tasks and reasoning. And that will be transposed to the physical world as a working assistant that never sleeps. And of course, it's going to materialize a little bit more into robotics very soon. And I already know that I'm going to get a ton of comments about Skynet and Terminator, so I may as well just embrace it. Look, I don't want this video to get too long, so from here on out, I'm just going to give you some cliff notes. Meta is another company that I bought a lot during this dip because of the criteria that I gave at the very beginning. Tariffs will have a relatively small impact on them because their hardware makes up such a small part of their business. Now, moving to the side a little bit, Amazon is one that I didn't buy because I already have a ton of stock from working there. But if I hadn't owned all that stock, I probably would not have bought it on this dip. Since a large portion of their business is in retail, tariffs will cause them to have a drop in top-line sales and their margin. There's no two ways about it. Their AWS business can't grow fast enough to counter the headwind pain that the retail side of the business is definitely going to feel. Honestly, I could go on and on for several more, but I'll just have to save that for another day. In shifting gears, I would love to connect with you, the viewers, in a little bit more of a meaningful way. I'm going to set up a virtual happy hour next Saturday to chat with 10 of you to see how it goes. If you could, just put the word drinks in the comment below, and then I can randomly choose 10 of you. From there, I'll give directions for the meeting. I can assure you that I am not doing this to sell you something or some other shady alternative. It's just a Q&A to meet some of you. Like I said, we'll see how it goes. As always, thanks again for watching.